But then I spent so many nights thinking how you did me wrong. And I grew strong, and I learned how to get along. So now you're back.
Hello everyone. We welcome you to the first game of the championship, which is badminton. Please make yourself ready, cause we will be looking at the completion of audit process and procedures. Audit process consists of 4 stages, which are planning, fieldwork, audit report and audit follow-up. In the completion of audit procedures, there are 6 steps taken by the auditor. First is review post-balance sheet events that occurs between the balance sheet date and the date on which the financial statement are authorized to issue, are called post-balance sheets events. Second is review financial statement. Auditor shall review financial statement in a manner that he is able to give reasonable basis of his opinion on the financial statement. Third is obtain letter of representation, which confirms the various representation made by management in respect of matters which are material and for which the auditor has not been able to obtain sufficient independent evidence. Fourth is send letter to management, it pointing out the areas where inefficiencies were observed and the suggested constructive advice for improvement in financial control. Fifth is forward points for consideration at subsequent audit. All the unsettled points have to be taken up at the next period and settled with the client at the start of next audit. Sixth is summary records of error. Auditor shall prepare a summary of all such errors and omission which have been observed during the course of audit and which have remained unadjusted. Post-balance sheet event, which also known as subsequent event, arises after reporting period but before financial statements have been issued or available to be issued to public. There are 2 types of post-balance sheet event. First type is adjusting event. This event occurs at the balance sheet date that could affect the company's financial reports. For example, bad debt. When an invoice issued at balance sheet date and client goes bankrupt after the reporting period, adjustment of allowance for doubtful debt is needed. Second type is non-adjusting event. This event did not occur at balance sheet date but have a material effect on the financial condition of the company. These events should be disclosed either through notes, supplementary table of data or pro forma statements. For examples, sale of equity, acquisition of another business, and etc. The field gets into its stride, which means decathlon is having started already. The third event, which is additional evidence in relation with contingency and commitment, will be starting. So let's start. Ready, set, go. Contingency can be defined as an existing condition, situation or any set of circumstances that involves uncertainty as to whether a gain or loss is possible to occur towards an enterprise. This possible gain or loss will be ultimately resolved when one or more event occurs or fail to occur. Contingencies which are resolved may lead to acquisition of asset, reduction of liabilities, loss or impairment of asset, or the incurrence of liabilities. Liability can be defined as a present obligation as a result of a past event, the settlement which would result in an outflow of economic benefits. The recognity on criteria is that there is a probable outflow of economic benefits that can be reliably measured. The difference between contingent liability and provisions is that contingent liability satisfies T. He definition of a liability but does not meet the recognition criteria of liability and is disclosed in the notes to the financial statements. However, provision satisfies both the definition and recognition criteria of liability. It is a liability with uncertain timing or amount and will appear in the balance sheet. Moving on to the second lap, it looks like there's a close gap to the finishing line. So before the race ends, let's look into the definition of commitment. Commitment can be defined as an agreement or pledge where a financial obligation is assumed at a future date, irrespective of whether anything happens to the economy or the profit. Companies often go into long-term contractual commitments. These commitments are made in order to acquire capital assets, for example acquisition of plant and machinery. Inquiries towards the management enable auditors to identify the commitments made. Such commitments are disclosed in the notes to the financial statements. Closing into the finish line and going concern concept wins the race. Going concern is an important assumption underlying the preparation of financial statement. The auditor needs to evaluate the going concern risk at the planning stage and final review, and whether the entity able to continue as a going concern for at least the next financial year end. Auditor has the responsibility to consider the appropriateness of the management's use of the going concern in preparing the financial statements. In disclosure of financial statements, auditor needs to be alert on the material uncertainties about the ability of the entity to continue as a going concern. These are the indications that needs to be observed by the auditor. 1. Operating indications. 2. Financial indications. 3. Other indicators. Examples of operating indications are loss of major market, franchise or principal supplier, shortage of important supplies and loss of management personnel. Inability to obtain financing, inability to pay creditors, net liabilities and net current liabilities and substantial operating losses are examples of financial indications. Other indicator is pending legal proceedings against the entity. There are 3 steps in going concern consideration need to be taken by the auditors. 1. Evaluate the result of audit procedures if there is any indication of event that may cause substantial doubt. 2. If there is a substantial doubt, auditor should obtain information about the management plan to mitigate the going concern problem. 3. If auditor concludes the management plan has substantial doubt about the ability to continue as going concern, auditor needs to consider the sufficiency of disclosure of the uncertainty and include explanatory paragraph in the audit report. Example of situation where auditor can satisfy with. For the indication liabilities exceed assets, may be mitigated by management's plan to maintain adequate cash by disposing asset or rescheduling loan. If there is a loss of principal, may be mitigated by availability of source of supply. It enables the entity to operate at least in the next 12 months. Normal audit procedures should be taken if a question regarding going concern arises. For example, analyzing and discuss cash flows, profit forecast with management, review events after the period end, for item that may affect the entity's ability as going concern, and review the terms of the debt and loan. Going concern assumption considered by auditors in audit conclusion and report. If the report is appropriate and resolved, no modification of the report needed. If it is appropriate because of mitigating factor should be disclosed in the notes of financial statements as unqualified audit report with emphasis matter. However, if there is not disclosure due to disagreement with management, audit report is considered as qualified opinion if it is immaterial and adverse opinion if it is material. If the result of going concern is inappropriate. If it is not material, it is disqualified opinion. If it is material, it is adverse opinion. If the result of going concern is not resolved, auditor needs to disclose the uncertainty in financial statement. Not material as disqualified opinion. And if it is material as disclaimer opinion. Are you ready to move on to the next game? Now we welcome you to the Golf Championship. But before that, let's look at the accounting estimates. Auditor must OBT. And evaluate audit evidence to support significant accounting estimates. Examples of accounting estimates are accrued revenue, depreciation or amortization, deferred tax, provision for loss from lawsuit, provision to meet warranty claim and net realizable values of inventory and accounts receivable. Management is responsible for making the accounting estimates included in the financial statements. Auditor is responsible for evaluating the reasonable of accounting estimates made by management. They normally consider the historical experience of the entity in making past estimates as well as their experience in the industry. Auditor may use one or a combination of following approaches. Review and test the process used by management. Develop an independent expectation of the estimate and review subsequent events or transactions occurring prior to the date of the auditor's report. Now let's move on to related party transactions. The audit of related party transactions is a difficult part, but it is very important in audit. As a result of fraud or error arising from related party transactions, auditor are required to focus on these areas. First, identify the previous undisclosed related parties or transactions. Second, substantial third-party transaction outside the normal course of business, and third, declarations that related party transactions are at arm's length. In order to improve the quality of audit, entity shall review th. SA action plan which focus on the specific areas on related party transactions, plan thoroughly the work on audit of related party transactions. Focus on the material misstatement risk that might arise from related party transactions. Understand the internal controls to identify related party transactions. Design procedures to respond to risks identified and perform completion procedures. Let's learn on the management and auditor's responsibility. In the situation where events occur up to the date of the auditor's report, auditor shall carry out He audit procedure which review the procedures management has established, read the minutes of meetings held after period end, read the entity's latest interim financial statements, inquiry of th. entity's legal counsel concerning litigation and claims, and inquiry of management whether any subsequent events have occurred which might affect the financial statements. Auditor shall consider whether the events are properly accounted in the financial statements. In a situation where events occur after the date of the auditor report but before the financial statements are issued, auditor does not have any responsibility to perform audit procedures, as management is responsible to notify the auditor of facts which may affect the financial statements, and once auditor is aware of the fact, they may consider whether the financial statements need amendment. Discuss the matter with the management and take appropriate action in a situation where events occur after financial statements are issued. Auditor is not responsible to make any inquiry. However, once auditor is aware of any fact that may have caused him to report, he may consider whether the financial statements need amendment. Discuss the matter with the management and take appropriate action. Audit Report Act as tool to report financial information to users, usually in business. Audit report contain auditor's opinion on whether the financial statements are presented in true and fair view, free from material misstatements, and in accordance with standards. There are two types of audit report, which are unmodified audit report and modified audit report. For unmodified audit report, auditor give an opinion that the financial statements are presented in true and fair view, free from material misstatements, and in accordance with standards. For modified audit report, auditor gives modified opinion because he is unable to obtain sufficient evidences and financial statements are materially misstated. There are three types of opinion, which are adverse opinion, disclaimer of opinion, and qualified opinion. For adverse opinion, an auditor is able to obtain sufficient evidences and in an opinion that misstatements are material and pervasive to financial statements. As for disclaimer of opinion, an auditor unable to obtain sufficient evidences and in an opinion that undetected misstatements could be material or pervasive or both to financial statements. And lastly, for qualified opinion, it consists of two situations. Firstly, an auditor able to obtain sufficient evidences and in an opinion that the misstatements are material but not pervasive. Second situation is an auditor unable to obtain sufficient evidences and in an opinion that undetected misstatements could be material but not pervasive to financial statements. Now batting, the second baseman, number 1, definition. According to ISA, key audit matters is matters that most noteworthy in audit, based on the auditor's professional judgment. Key audit matters are selected from matters communicated with the persons with responsibility for overseeing the strategic direction of the entity and obligations related to the accountability of the entity. The first batter goes to first base on a 4-ball count. Next, the requirement is in the batter's box. In making this determination, the auditor shall consider areas of significant auditor attention in performing the audit, including Areas identified as significant risks in accordance with ISA. Areas in which the auditor encountered significant difficulty during the audit. Circumstances that required significant modification of the auditor's planned approach to the audit. The auditor's report shall state that key audit matters are those matters that most important in the audit. Key audit matters are selected from matters communicated with those charged with governance but are not intended to represent all matters that were discussed with them. The auditor's procedures relating to these matters were designed in the context of the audit of the financial statements as a whole. The auditor's opinion on the financial statements is not modified with respect to any of the key audit matters, and the auditor does not express an opinion on these individual matters. The description of each key audit matter shall include an explanation of why the auditor considered the matter to be one of most significance in the audit, a reference to the related disclosures. If the auditor determines that there are no key audit matters to communicate in the auditor's report, the auditor shall discuss this conclusion with the engagement quality control reviewer, communicate this conclusion with those charged with governance, explain in the auditor's report that this section of the auditor's report is intended to describe the matters but has determined that there are no matters to report.